Does a 4% rule still work? The short answer is yes, but it's no longer a set it and forget it rule. The 4% rule basically says that in retirement, you should be able to withdraw 4% of your savings, your life savings, your retirement dollars each year, adjusted for inflation, and that you won't run out of money. But a couple things here. Number one, the rule does still work, but as a baseline guideline. Okay, so it's not a rule for everybody, obviously. Number two, most current research suggests slightly lowering the starting rate. So instead of 4, maybe thinking about 3.5% to 3.9% for added safety. But number three, and the biggest thing I think here is that flexibility matters more than the exact percentage. And I really believe that flexibility in terms of your income plan and retirement, especially in those early years, those first 5 to 10 years of retirement, is really key. So let's dig into the research, see what the latest research says over the last year about the 4% rule. And there are 6 things that I want to talk about when it comes to what the latest research says about the 4% rule. Number one, the new safe range of withdrawal rates is slightly lower than it used to be. Morningstar, as an example, 2025 said the starting withdrawal rate should be about 3.9%. Other 2026 analysis, roughly 3.3 to 3.7%, depending on your assumptions and circumstances. And finally, some forward-looking simulations suggest even lower rates in worst-case modeling scenarios. So a 4% withdrawal rate isn't wrong. You might just have less margin for error today. So flexibility is key, and obviously one size doesn't fit all. Number two, even the creator of the 4% rule idea has adjusted his rule. The creator of the 4% rule was a financial advisor back in the 90s named Bill Bengen. He invented the rule, now says it was too conservative and many people can actually spend more. His updated research suggests that many retirees can actually safely withdraw closer to 4.7% and says sticking strictly to 4% may mean you're underspending or cheating yourself. That's what Bill Bengen has to say. So the right number isn't one number anymore. It's a range depending on your setup and your own customized and personalized plan. Number three, why does the rule feel less reliable today? Well, experts consistently point to 3 big structural changes. Number one, lower expected returns. Future stock and bond returns are projected to be lower than the past decades. Why? Because we've been on an incredible bull run, really since 2008, and we've had some hiccups, 2020, 2022, but the last handful of calendar years have just been tremendous in terms of market returns when you look at major indexes. So naturally thinking that in the future, returns might be lower, might be something to really consider. 2, higher and unpredictable inflation. Inflation volatility makes fixed withdrawals riskier over time. Number 3, longer retirements. People are living longer than they ever have before. Many people will need income for 30 to 40 plus years, not just 30 years. Bottom line, the original rule was built on a different economic world, and that was 30 years ago when Bill Bengen created that rule. Number 4, the 4% rule still works, but under specific conditions. If you retire at 65, you have a 30-year timeline having a balanced portfolio that's typically 60-40, stocks, bonds, and adjust your spending if markets drop, then the rule is still valid. Number 2, in fact, historically, it works 95% of the time under those assumptions. Number 5, where the 4% rule starts to break down. You are at higher risk if you retire early, right? So if you're talking about retiring in maybe your mid to late 50s, that is an early retirement. Now you're talking about retirement for a longer time horizon, maybe 40 to 50 years. You are at higher risk if you do retire early. You're at higher risk if you refuse to adjust spending during downturns. That is sequence risk, the risk that when you're pulling money out of your portfolio, the markets are also down at the same time. You are at risk if you're heavily invested in one asset class, typically equities and stocks. You are at higher risk if you hit a market crash early in retirement, that sequence risk I just mentioned. Number 6, part of the research here that's been done lately. Modern strategy is that flexibility beats precision. Today's best practice isn't just pick a number and stick with it. Instead, adjust your withdrawals based on market performance. Also, spending isn't linear, right? Your spending in retirement isn't going to go like straight up the rest of your life. Your income might be higher, your needs might be higher. You might want more income and cash flow in those first 5 to 10 years of retirement so you can travel and do the things you want to do, spend more money then, obviously, than when you're 83. Spend less after bad years, more after good ones. Combine withdrawals with Social Security timing, cash buffers, right? If you've got 1 to 3 years of expenses in cash that you can use bonds, annuities, structured notes, all kinds of safer instruments, treasuries for stability. This can safely support higher starting withdrawals, 4+% if managed dynamically. In closing, the 4% rule is not dead. It just grew up and has changed. Economic conditions are different than they were 30 years ago when the rule came out. Today, it should be looked at as a guideline, as a baseline, as something to make a decision off of. It may be lower or higher for you. Key takeaways. Use the 4% rule as a starting point, as something to understand when you start to take out income from your portfolio and life savings in retirement. If you want more safety, consider a withdrawal of maybe 3.5 to 3.9% or lower if you retire early. Have a flexible spending plan that is adjusted each year. Build up backup income, that's Social Security, cash reserves, and things like that. Have an income plan and strategy customized to you and your goals. Everyone's needs and goals are different. Finally, we can help. Just go to our website, click the link posted here. That'll take you to our website, and you'll be able to have an exploratory phone call and a meeting with someone on our advisory team. We look forward to speaking with you soon.